What's going on, you guys? My name is Zach Hartley, and in this video I'm going to tell you how I manage my position sizing and diversification when I'm doing different types of trading. Here's everything you need to know. Let's go. Alright, so when I talk about position sizing, it is really simple. There's no need to complicate this. When I say position size, I am simply referring to how much money you put into each position. So if you have a portfolio of investments and one of them is your house, one of them is a variety of stocks, one of them is some bonds, what I am talking about when I say position size is how much of your money is in each of those positions, each of those individual stocks, each of those bonds, and each of those individual properties. That is what I am referring to. Now, when I refer to diversification, what I am talking about here is the correlation between those positions. So correlation means how much they're related to each other. So if you have a bunch of stocks, but they're all in the electric vehicle industry, those stocks are going to be very heavily related to each other. However, if you own 5 different stocks in 5 different industries, those stocks are not going to be correlated. They're not going to have a tight relationship and move together. And so that is going to mean that you have some diversification in those 5 stocks in comparison to the same 5 stocks that are all in the electric vehicle space. Now, this is super important because what you'll find is that industries often move together. And so these are some screenshots that I've taken from my trading over the last few weeks. This one was actually taken on December 14th, and this was the magic mushroom kind of psychedelic space. And as you can see, almost every single stock in this industry moved by 18 to 68%, 68, 63%, absolutely amazing movement here. And this movement basically encapsulated the entire industry. Now, if you look on the other side of it, this is a screenshot taken on a different day of the electric vehicle industry. And as you can see, nobody was saved here. Not even Tesla. Nobody made it out of this day basically doing well. Everybody was in the red this day, and it's because the industry got bad news. And so what I'm trying to show you here is that it can go both ways, but usually when it goes strongly in one direction, that entire industry moves. And so if you have your entire portfolio in electric vehicle stocks and a day like this comes around, your entire portfolio is going to take a hit. However, if these two photos were on the same day and you had some of your stocks in the psychedelic space, you would have done okay. And so that is the advantage of diversification. And now when we talk about the advantage of diversification, we can actually put that on a graph. So this is what the graph looks like, and it's really cool. So on the bottom here, you have the number of stocks, or basically number of positions. And so the more positions basically goes further out to the right. And on the left-hand side here, you have risk. Now this is usually determined by standard deviation, or basically the fluctuations in your portfolio. And so as you can see, as you go further along, you actually decrease your risk, and the more stocks that you have, the lower the risk becomes until you get to this level that is called the non-diversifiable market risk. And that is basically if the entire market crashes, it doesn't matter how diversified you are, you're still going to take a hit. However, up to a certain level, you do gain some safety by having a diversified portfolio, and that level is kind of right about here. So kind of around the 15 to 20 position level, it's kind of a deteriorating return where adding more positions and diversifying your portfolio more isn't actually going to reduce your risk, and you're just adding more commissions and more management to your portfolio. And that kind of golden zone, that 15 to 20, 25 positions is kind of where you want to be to say that you have a diversified portfolio. And so when we look at a long-term portfolio, somebody that is building up a portfolio for retirement, for long-term savings, for a house, for a long-term investment, maybe they're looking for cash flow, whatever it may be, the ideal position here is going to be 15 to 25 positions. Anything more than that, and you're just paying additional commissions and you're not really achieving more diversification in your portfolio, you're just kind of spreading the wealth out a little bit more. But that 15 to 25 position level is where you want to be to have a diversified portfolio. Now, if you have 15 to 25 positions, that means that you're going to have roughly in that range of 4 to 12% per position. Now, what I would recommend is keep your favorites around that 8 to 12%. Keep the ones you're maybe a little bit worried about, or you don't know enough about them, or you're still a little concerned about them. Put them in that 4 to 6 range. And anytime that a stock gets above 12% or maybe above 14%, that is when you should rebalance your portfolio. You should take some of those profits. You should put that money into different stocks, or you should spread that money out through the rest of your portfolio. That is how you rebalance your portfolio. And when you do this, when you have 15 to 25 positions of that 4 to 12% position size, I highly recommend that you have at least 5 different industries. That is going to give you adequate diversification between those positions, and it's going to give you good position sizing so that you can achieve steady and consistent returns throughout the years. Now, I get asked about my long-term portfolio a lot, and this is basically what it is made up of. So when you look into here, I focus on kind of 5 different industries, and these are the companies that I focus on. So in technology, I'm really heavy on Square, Amazon, Google, and Facebook. I think those are the best best business models in the technology space. I think those are the companies that are going to be much more important 5, 10, 15 years from now. I think they're all going to do extremely well. I am also super interested in the transportation space. Obviously, airplanes and consumer travel has taken a hit. However, I am really excited about Tesla, Drone Delivery Canada. I think Uber is going to be the primary mode of transportation for short and medium long distances in the next 20 to 30 years. So I really like that ride sharing business model. And air cargo is only going to increase. So I really like Cargojet, a Canadian company. The other industries that I like are food, gaming, and the work from home space. I think work from home is only going to grow. So I like Upwork and Fiverr. I really like gaming. I actually just made a swing trade on Electronic Arts and I made 100% on that return. I also like Activision. I think both of these companies have good management and are going to grow over time. And I think the food space is ripe for takeover right now by these plant-based products, these meat alternatives. I think the food space is changing drastically right now with the food delivery, with the meals that are ready to go and delivered to your door. I think the food space is changing just drastically right now. And I think a lot of these companies here, Good Food Company, Beyond Meat, and Very Good Butchers, are all very well positioned to take advantage of that. So this is what a lot of my long-term portfolio looks like. Now, if you guys are interested in learning how to actually pick out these companies for yourself, I do offer a stock market course that is completely free when you sign up for a 2-week free trial on Skillshare. After that, it's about $20 a month, but you can cancel at any time. So if you do the entire course in under 2 weeks, you get the whole thing for free. There's over 750 students, over 45 plus reviews. There's 9+ hours of content, and I promise you it will be the exact same as every other course out there that charges $500 or $1,000. You'll get the exact same content and the same value completely free. The link is down in the description. I highly recommend it for any new traders. Now, when we start talking about swing trading, things get a little bit different because 20 positions is just too much to keep track of. If you're swing trading, you want to be looking at those positions every single day. You want to be analyzing them and keeping up to date on the news. 20 companies is just way too much to do that on, especially if you're still looking for other positions or you have anything else going on in your life. That is just a lot to manage. So what I say when it comes to swing trading, you need to choose the number that you can manage. Typically, when I see swing traders, it's usually in that 3 to 10 range. Anything more than 10 just becomes a lot to manage every position and stay on top of it. Anything less than 3 and you maybe get bored a little bit because it's not super active and you're not doing a whole lot. But that 3 to 10 range is sort of the Goldilocks range that I see most people falling into, and that's definitely where I fall when I'm swing trading. I usually have that 6 to 10 level so that way I can check every stock every day. I can stay on top of the news. I can look for new opportunities and I can do anything else that comes up in my life. That seems to be kind of the Goldie spot zone for me, and it allows me to watch those stocks each and every single day. If I need to get out of that stock before my stop loss, or I see something that I don't like, it gives me the ability to do that with every single stock I'm in and do that every day. Now, when it comes to position sizing for my swing trading, I always hold some cash. Between 5 and 15% of my portfolio is always going to be in cash. Number one, that gives me the ability to execute on any opportunities that I see come up when I'm fully invested. And number two, if I need to pull some money out of my account for any reason, I get in a car accident, I need it for insurance, whatever it may be, I've got some cash that I can pull out without having to close any of my trades. So I think that is a rule that all swing traders should kind of have in their back pocket, is keep a little bit of cash and then you divide the rest of your money, that 80%, that 85% divided by the number of positions that you hold. Let's say it's 6 positions that you like to have. That's how much should be your full position in any stock. Maybe you build into your positions in 2 chunks. Depending on your strategy and how you operate, that is how I think you should be swing trading. Take your full portfolio size, save a little bit of cash left over, divide it by the number of positions that you can manage, and that should be your position size for swing trading. But make sure that you set a hard stop loss. That is something that a lot of people don't do, or that they forget, or they move it down. You need to make sure that you set a hard stop loss when you are swing trading, because when you swing trade, it is better to get out early because you are wrong than to ride that wave all the way back down. You can always buy in at a lower price, but you do not want to be averaging down when you are swing trading. That is the wrong methodology. Cut the losers quick, buy back in at a lower price if you still like it, and move on. Now, when it comes to diversification in swing trading, it is just as important as it is in long-term investing. The reason is because you're holding these stocks overnight. Anytime you hold these stocks overnight, news can come out in the morning, news can come out overnight, news can come out overseas, and it can drastically impact the industry that you are invested in. So if you're swing trading, you still need to be diversified. You need to be spread out into a couple of different industries. Anytime you hold those stocks overnight, you risk the chance of a huge gap up or a huge gap down for the industry. And if you're not diversified, it will destroy your portfolio. Now, if you guys are interested in seeing how I swing trade and my analysis and my charts behind my swing trades, then you should definitely consider joining my Discord chat. That is where I post all of my technical analysis, my weekly watch list, and I'm trying to build a community of traders where everybody else shares their own resource and their own analysis. So if you're interested in that, there's a link down below. It is $5 per month, and I post as much as I possibly can in there. And I'm trying to build a community of traders so that nobody has to sit at home alone and trade by themselves. This is where you can bounce ideas off the wall. Now, when it comes to day trading, I usually recommend between 1 and 3 positions. Anything more than that can become a little bit difficult to manage, especially if there's any news coming out in the middle of the day. Any Fed reports or rate hikes can really mess you up if you're day trading with more than 3 positions. And so when you're day trading, you must have a stop loss and you must have a target for that trade. Those two things allow you to put together a risk-reward ratio. And when you combine that with your percentage win rate, you can then determine what your overall profit and loss is going to be. Your overall percentage win rate and your risk return ratio are the 2 largest factors when it comes to analyzing your trading, and you need to know both of those factors because that determines your ability to succeed. Now, when we talk about position sizing and day trading, it is completely up to you. You can invest 100% of your portfolio. If your stop loss is 5% below where you entered the market, it doesn't really matter how much money you have in there. It is the risk of your entire portfolio. You're only risking 5% of your portfolio on that trade, so it doesn't really matter how much money you have in there. If you invest half of your portfolio, but you have a 10% trailing stop loss on there, you're risking the same amount as if you had invested your entire portfolio with a 5% trailing stop loss. So you really need to understand your risk management strategy is the most important thing when it comes to day trading. Now diversification does not matter at all when it comes to day trading. The reason for that is that you are not holding these stocks overnight. So if the industry turns around in the middle of the day, you should be able to realize that and you should be able to understand it because you are looking at it. It doesn't matter if you own 3 different positions all in the exact same industry, as long as you understand the market and what is going on with those 3 stocks and you have an appropriate risk management strategy for all of those trades. It doesn't matter if they're all in the same industry. Diversification does not matter when you are day trading, as long as you can recognize what is happening in the markets, and if you see a turnaround, your risk management strategy needs to kick into place and get you out of that trade. Now, just a couple of notes on everything that I've said here. This is all just my strategy and my opinion. This is how I look at the markets, and it is a good way to look at the markets, but it is not the only way to look at the markets. There are several other traders, even here on YouTube, that have a lot of success using other strategies. And so when it comes to the markets, there are several right answers, and you just need to figure out what works best for you because everybody trades differently. Now, if you guys are looking for a day trading broker, I highly recommend Questrade. I personally use them for all of my investing, and if you use the link down below, you will get $50 in free commissions. I use the software every single day. Most of the people in my Discord chat use it as well, and I highly recommend it. Now, in summary here, position sizing and diversification are 2 of the largest factors that you need to recognize and understand when it comes to your trading. Those are the 2 factors that are going to save you from blowing up your account and help you generate long-term steady returns. So if you guys get any value out of this video, please consider hitting that like and subscribe button. I sincerely appreciate it. Good luck trading, good luck investing, and we'll see you tomorrow for the weekly watch list.